S&P is rising for its sixth straight day. My next guest says still time to be defensive, though. Joining me now at Post 9's Chris Toomey of Morgan Stanley Private Wealth Management. Welcome back.
Thank you.
You heard what Rick Rieder had to say. He's reasonably positive, I think, on the bigger picture, but suggests equities are still a little too rich right here. You agree with that?
Yeah, I think so. I think our view is we're kind of range bound right now. We're probably at the top of the range. I don't necessarily think a lot of that uncertainty that Rick was talking about has cleared up. If anything, I think things are getting a little bit worse. And so from our standpoint, I think the market was digesting a lot of this uncertainty. We saw that correction. Naturally, you'd see kind of a 50% retrenchment. The concern is that, normally that means they're going to test it. From our standpoint, we wouldn't necessarily be buying here. We'd probably be kind of buying more at the lower ends of these ranges.
Yeah, and you anticipate the market having another episode?
Yeah, I think so. I mean, look, until we get some real clarity on a couple different issues, I don't think we're really necessarily going to get very bullish on equities. I think we want to see something with regards to a resolution with China as far as kind of what the name of the game is going to be. We want to see probably a more dovish Fed. We want to see maybe the 10-year dropping below 4% without a recession, which I know Rick was talking about. And then we want to see some breadth of earnings. I don't know that any of those things are going to get resolved in the near future. So for that reason, I think we're going to stay defensive.
Wow. I mean, you got a lot of things on your list that you want to see. Do you think you can get any number of those paired together in the near future?
Not for the near future. I think, one of the things that we're really concerned about, as Rick mentioned, is looking at the labor market. I think a lot of this is about bringing jobs back to the U.S. You're in a situation where the largest employer, Walmart, isn't providing guidance. That's 2.1 million people that now don't know necessarily whether they're going to be hiring or firing or what have you. UPS just laid off 20,000 jobs. You've got Amazon in the news. Those are all major employers in the U.S. And so if we have some real concerns with the labor market, I think that starts tipping us more into kind of the recession camp.
What do I do then? I mean, what are you telling your high net worth clients?
So, I mean, look, part of this is going into this knowing that there was going to be a fair amount of uncertainty. And so we were underweight equities. We continue to remain underweight. I think you want to stay in the largest, kind of highest quality area that Rick was kind of alluding to. I think there's also opportunity in other areas of the market. We saw a situation where equities were selling off, bonds were selling off at the same time. Speaks to the benefit with regards to alternatives, whether it's hedge funds, whether it's looking at things like private credit, or just looking into opportunities within the private equity market. I think the other thing is not trying to make this too complex. You saw in the Masters, Rory had a 5-foot putt to win the Masters. Sometimes it's about just making that 5-foot putt. If you look at, the fixed income market right now, munis on a tax equivalent basis, you're looking at sometimes 7 to 10% tax equivalent yields. You know what? That's pretty attractive right now while you're waiting for this uncertainty to pay off.
Because, I mean, this period, as I said at the outset, not just the 100 days in total, but what you alluded to, certain parts of the market, bond yields going up, the dollar not doing what it normally does in periods like this. Munis went through their worst day in some 31 years. And I also read stories about private credit finally cracking.
Yeah.
So address that, because our viewers, some of whom surely have access to alternatives through their financial advisor, are hearing that and saying, but I keep hearing other people come on the network and saying the runway for private credit and alts is long.
Yeah. No, look, I think it's one of those things where you need to know what you own and who's managing your exposure there. I think in our sense, there's still opportunity in private credit with the right managers. You don't want to necessarily extend in overweight within private credit. One of the benefits there is, in many cases, they underwrite these loans. They're hedged against rising interest rates. So if Treasury yields go higher, you're somewhat protected. And the fact of the matter is typically the default rates are relatively low and the recovery rates are very high. So if you're well diversified, you're with a very good manager. Even if we go through a period of situations where you start to see bankruptcies in that space, you're still at kind of typically a top of the capital stack and in a pretty good place.